Okay, folks, welcome back. Appreciate your patience this weekend. As I mentioned on Twitter, and then last week we were preparing for our sister's wedding yesterday. So thank you very much for allowing me a little bit of a leeway in terms of delivery. Still before the market opened up, so it is what it is. But I'm very appreciative of you all not hammering me in email and such. Where's the video? So here we are. We're looking at the calendar for the coming week. Monday we have a bank holiday for Canadian dollar. GBP at 12:30 during the New York session. We have a member speaking, and medium impact FOMC member speaking at 1:05, and then Fed Chair Powell speaks at 7 p.m. Tuesday we have inflation report hearings, high impact for London Open GBP, and two members are speaking during the New York session for the dollar. On Wednesday, we have a member speaking at 1 a.m. Kind of weird time there. Then 4:30 a.m., we have CPI for GBP, high impact. And on 8:30 a.m., we have a high impact core retail sales for Canadian dollar. At 10 a.m., we have a medium impact FOMC speaker. And then 2 p.m., we have FOMC minutes. Thursday, we have French flash services PMI, and it's high impact for Euro during the London Open. And 3:30 a.m., German flash manufacturing. Very, very busy Euro session on London for Thursday. Then we have ECB monetary policy meeting accounts and European Parliament elections. Okay, so very, very impactful on Thursday this coming week. And then retail sales for GBP in Friday's London Open. And again, European Parliament elections continue for Euro. And New York Open, 8:30 a.m. News embargo lifts. And we have core durable goods orders for dollar index. And it's high impact. And we have Treasury currency report, medium impact, which is tentative for Friday. And that's our calendar looking ahead. Let's go over to our charts. Okay, so we have our dollar index. This is a daily chart. Now this is AVA demo. So AVA trade demo accounts being utilized here. I'll mention on the GBP, and when we get to that section, that you may have noticed there's a slight discrepancy in the delivery of price on the chart I shared on the forum last week. So I mentioned on Wednesday I would not be able to, or may not be able to, do a video, and I was not. So I posted a chart and asked you all to study the specific points of liquidity on that GBP chart. So that was using IC markets. So I'll mention that when we go into GBP. But for right now, and for clarity's sake, we're looking at AVA demo, or AVA Trades demo, for the dollar index here. Okay, so for transparency, I'm still weighing AVA Trade, IC markets, Oanda's demo. There's, it's just like, it's hit or miss. When one's doing okay, or I like something about one, something else looks more appealing in the other. So it's becoming frustrating for me. So that's why I'm just staying with AVA for right now, and until I come to a real strong conclusion about what I want to use going forward. So I'm just sticking to what we had moved from when we lost access to Forex Ltd's demo. Everyone's account went on the fritz. So that was the only reason why we changed accounts. That was the only reason why we changed the brokers for our demo account, Medium. So that way everyone's looking at the same thing for learning purposes. But just as a reminder, we may not stay with AVA Trades demo. It may eventually move from this, or it may not. Depends upon what I glean from looking at the others. So far, I'm not real impressed with Oanda, so I'm just letting you know that now. But anyway, IC markets is pretty decent because it gives you the bonds. So if you're an S&P trader and you want to track that, it's a really good demo account, in my opinion, for doing that. But again, I'm deviating from the focus here. So dollar index, we had over 100 pip move last week. We had this low here, and we had an order block outline between the two. Consequent encroachment, hit that beautifully, ran sell side liquidity. We were bullish, firm, consolidated to bullish on dollar index. I kept the narrative in line with that 98.40 level, which is that weekly inefficiency. I'll drop up here into a weekly chart. That's this up here. I still think, again, that's the draw on liquidity. It's just taking a long time to get there. And I mentioned that it could stay in a consolidation. Okay, I didn't feel that we were breaking down. So for context, okay, I did not want to see, and I did not believe we were breaking down. Okay, so just to be very clear about that, it's important that folks don't take what I'm saying out of context and throw it on Twitter and try to create some kind of a ridiculous narrative. We were bullish on dollar with the expectation that it could still stay consolidated, which is what we see here. It's inside the range. Did not break down. We're aiming for still to draw on liquidity at 98.40, which is that weekly CIVI, sell side imbalance, buy side inefficiency. I also mentioned in context that while the dollar index can stay in a consolidation like this and still be relatively firm, and what I mean by that, it's not going to go lower. But when I say firm, it's reluctant to go lower, but even though we have a modest bullish stance, or at least I'm holding that for dollar index, I'm not expecting some explosive move on the upside on the dollar index. And that was what the context was the last 2 weeks, in fact, on dollar index. So again, we had a nice little move here, over 100 pips for dollar index, which, in recent months, that's considerable. Okay, it's not modest, it's considerable. You got to look at the average daily range, and we're looking at something that was predictable. We talked about it, and it came to pass. The real focus was that while the dollar index could be maintaining the consolidation and being firm, reluctant to go lower, that is still bearish for foreign currency. So if we move into a 4-hour chart, you can see that run on liquidity here came down, just overshot consequent encroachment, and then we've rallied up. Next draw on liquidity is here. I mentioned on Twitter there's 2 equal highs. I got a couple questions by way of email that I'm not going to answer independently. I'm just going to answer it as a blanket response, so it'll save me some email time. So if you did email that question to me and I don't get you a response, I'm answering it right here. Okay, the equal highs I was mentioning, there's 2 of them. These here, right here, and then these right here. I like these for this week still, but I like it only until we get to Wednesday. So I'd like to see it run that ahead of the FOMC minutes. That's the ideal scenario for me. If we don't run it and we stay above this low here and below these equal lows, then we might see that shoot up there and run above that there during the FOMC minutes release. So it depends on what we get for the build up for the week. From a weekly template, so to speak, ideal scenarios are Monday and Tuesday. They're your ideal trading days for this week because we have FOMC. Okay, and then some of you, it's only the minutes. It still does not change the underlying narrative that can be utilized because FOMC is a deal breaker. No matter how you slice it, they can always use that as a smokescreen and change gears. Okay, so just bear that in mind going forward. On an hourly chart, you can see equal highs here and then the equal highs here. So we have buy side liquidity pool here and this one here. I don't think that they would be, satisfied just to clear these when they're so close to this. So again, just look at that 98 as our target for this week. And what we do above that, I'll have to see. But 98.40 is still the long-term or intermediate term draw on liquidity for me for the dollar index. What would change that is we would have to take out the low formed on May, 10th? what that is? No, May 13th. Okay, so May 13th is low. So as long as we're above that, I'm still staying dollar bull. Okay, so there's your catalyst for me to change camps. Moving on into euro dollar. I mentioned last week that should I be wrong about my expectations on the dollar index and say the dollar index moved lower, the pair to trade on the upside was going to be euro dollar, and that would be filling this gap here and then the equal highs here. That's in context. So I elected to tell you that my belief was that we were going higher on the dollar. That was like gun to my head. What am I going to have to tell you? That's it. Firm to bullish on the dollar. So that means bearish foreign currency. That's the narrative. That's plan A. Okay. But had I been wrong, and it's likely to happen in the future, it's certainly going to happen in the future. But if I were to be wrong in my assumptions on what was expected last week on the dollar index, I counseled you to look at the euro dollar as the currency pair to buy if it was in fact going to see a weaker dollar. Okay. So again, that's context, Robert. So we have equal lows, pseudo equal lows here. That's the draw on liquidity. So I think that's going to be the focus for this week. We have already used this order block here, and that's why it's here just in very, very light lettering, just to show it's already been used. So I don't think we have a reclaimed order block scenario coming down here. I think that we'll try to reach below these relative equal lows. So I think that's going to be our focus for euro dollar for this coming week. And if we look at what we got for the hourly chart, it's been rather ugly. Okay, we've had some runs on liquidity. You know, when we have a stronger currency, as we show here, here's the euro dollar, and you can see that we've had euro making higher high, cable failing to make a higher high in euro, lower high on cable. Again, the algorithmic macro is going to be the stronger currency. If it's going to drop lower, it will only do so. No, let me rephrase that. It will most likely do so after it runs buy side liquidity. Okay, so it's like turtle soup sell signal. Higher high, sell it. Higher high, sell it. Equal highs, higher high, sell it. Equal highs, higher high, sell it. Liquidity pool, buy side liquidity, ran it, sell it. Okay. On the weaker currency, you're looking for fair value gaps to be filled. Okay, so more likely for it not to create higher highs to run buy side liquidity. It's too heavy. So it's only going to want to return back to fair value. And what I just mentioned there, I've mentioned in passing a couple times over the last few months. So if you're not writing that down, you are really missing a huge insight. And that's the reason why we focused going short on cable. And we're not trying to sell short the euro dollar. Even if it does drop, which it has done modestly, not to the degree that we saw GBP USD decline, which is the currency pair we focused on as a short last week and have been focusing on since the non-farm payroll. If we go back to euro dollar, again, this is that relative equal lows. I think that's the liquidity pool that we'll work with as a downside objective. So 111.10, we'll see that as an objective for this week if we see continuation on the downside. I am not electing to sell short euro. Now, it can close the gap and get in sync with the weakness that's been shown in cable, or it could stay as it is here, sideways consolidated. And while it does have tradable declines, my method and my approach to analysis is I don't want to sell short the stronger currency. That's just the way it is. You don't want to sell underlying strength. Now, at some point, if we do get that run on the dollar, and it makes a really aggressive run for that weekly SIBI, and it's no guarantee that it will, okay, but it's a draw on liquidity for me, which builds the case for a bullish dollar still for me. That still can allow euro dollar to drift lower. But notice how it's having a difficult time. Okay, some of you have vented on social media that you're having a difficult time. You're struggling with this because you're trying to sell short Eurodollar. Okay, well, hopefully you're learning, because I've told you in advance that you should have been selling cable over Eurodollar. Okay, so you can either listen to me or you can arm wrestle me and try to be smarter. Okay, and whichever you want to do is fine, but I'm here to try to save you all of the grief. But if you want to go through it, be my guest. So moving on over to cable. Beautiful, beautiful decline here. All right, so what we have is this old low. I mentioned on Twitter, I said, what is cable reaching for? Well, it's the old daily low here. And then once we expanded down below, which I am really surprised that it moved this much on Friday. So I'm going to be real honest with you. I felt that we had moved enough for the week when I tweeted, look inside or read between the lines. That tweet, look at that, it's relative to the cable. It moved another, like 50 or 60 pips or so lower. Very, very heavy. Very, very heavy on cable. This low here, I've identified in relationship to this candle's high, and we have consequent encroachment here, okay, right in the middle. So 126.58 is really the level. I don't know why it's showing up that, but 126.58 is consequent encroachment. It could trade down to that, if not all the way down into this candle here, which its high is 26.46. I'm not that ambitious. I'm just saying that if we continuously drop, we're going to look to sweep that low. So I'm going to do everything with the Ava trade. The reason why I had to use IC Markets demo is, for whatever reason, Ava trade did some kind of acrobatics with its data, or magic trick, made some data missing. So since, in my opinion, I think they corrected it, but I haven't gone back and looked at it that extensively. But the 4-hour chart on cable, if we look at the buy-side liquidity pool here, they ran that. This is non-farm payroll. Now I'm going to counsel you to go back and watch that video for that weekend. So after non-farm payroll was released, you'll hear me say that many times non-farm payroll is the Judas swing for the month. Now, does it always happen? No, it doesn't always happen. There are signatures that you look for, and some of them are seasonal tendencies, as you see here. Here's the seasonal tendency for British pound. You can see in May we decline after an initial run up, like we see here. Runs buy-side liquidity. They use non-farm payroll numbers to provide the smoke screen, if you will. And if you remember, if you're going through all of the mentorship for the students have been here for a while, I didn't mention the non-farm payroll being a Judas swing for the month, for the first time in May. Every time I talk about non-farm payroll, I invariably will mention that, because it's something that if you incorporate seasonal tendencies, market structure, market symmetry, if there is a specific time of the year when a market is predisposed to go higher or lower, and you get that type of price action like we have here, then you can pretty much expect it to unfold. Now, I have the dividers here, the time dividers on the 4-hour chart. Every one of these vertical lines represents a full week of trading. Okay, so here's the lesson for this week. We have the initial consolidation that bridged 1 week into the next. Then we have a rally up, decline, reaccumulation, runs up. Clears the buy-side liquidity pool. Okay, does so on non-farm payroll. We begin a new month and a new week post non-farm payroll. We want to wait and see, does the market want to decline? It does. Has a nice distribution candle here. Fair value gap is created. We trade right back up into it. There's your sell. That is your low risk sell. This is your smart money reversal. I don't need to get in at a smart money reversal. I anticipate it, but then I look for this to occur. Okay, and there's your low risk sell short. Then you look for areas to be distributed again. So you look for a redistribution. Another fair value gap. Okay, paired up with the curve over here where there was accumulation. Now there will be distribution. Everything has to be balanced out. Then the market trades down lower, breaking market structure here. For editorial traders, from the stuff I've shown for almost a decade now, this is the breaker. They want to see it break. If it trades back up into it, they'll sell short there, which is fine. But look how much time it stays in mitigation. Okay, these are 4-hour charts, 4-hour candles. This is a rather lengthy amount of time staying in a breaker. So whatever they use to participate in this long move here, they're really having an opportunity to get out of that and go short. Market breaks down, creates another fair value gap, trades up into it, sells off again. So redistribution. The original consolidation in here, we have sell side liquidity. That's the draw on liquidity. We go down to the equilibrium price point of that original consolidation, and then we offer another opportunity for selling short at equilibrium. Again, this is a 4-hour chart. In this area, we would look for a lower time frame fair value gap 2. Remember, this is the weaker of the pairs. Cable, weaker than euro. And the market makes a mad dash below for the sell side liquidity, and then just stays heavy and just keeps on rolling, along with the seasonal tendency for this month for cable. Dropping into an hourly chart, right in here, we're going to study this. Okay, this equilibrium. If we drop into a 15-minute chart here, I'm certain we'll probably see a fair value gap. Now, I don't know, I haven't looked, and I might be wrong, but we're going to see. But look at what we have here on the breakdown on an hourly chart. We have the weekly dividers, which is the double lines here. That's a new week starting, and a new week starting. For a swing trader's perspective, you could be selling short up here and aiming below this area here. You could be selling here as a swing trader and aiming below these lows. You could be a day trader in every one of these instances. Okay. You could be a one-shot, one kill trader on a Monday, Tuesday, or Wednesday using any one of these PD arrays. Okay, or points of reference or liquidity as outlined on the chart I shared on Wednesday. The best one-shot, one kill is going to happen at or just after the mitigation, because that's when the range expansion is going to be the magnitude is going to be larger. Okay, so the more speed, the more one-sidedness the market's going to be, is going to occur after mitigation, because that's where they're accumulating or redistributing, okay, a heavier book of selling short versus carrying longs. That would be their book was heavier net long here. Now it's heavier net short here. So we have a market maker sell model: consolidation, reaccumulation, smart money reversal, low risk sell, distribution, 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 and then boom. And then we just doesn't have any legs to hold it up. We drop into a 15-minute time frame right in here. Here's equilibrium, and we'll zoom in just a little bit more. Right here. Previous candle, one candle down, the next candle's high, this low, this high, there's your fair value gap, trades right up into it, bam. There you go. Fair value gap at logical levels of liquidity. Nothing mystifying about it. It's the same things over and over and over again. But you have to wait for these instances to come, because these are signatures that will repeat over and over and over again. When we get into 2020, next year, I'm going to be teaching you the algorithmic side of the market. So it won't be just charts, candles, patterns, breakers, order blocks, none of that. Okay, it's going to be the why these things are going to be elected over others and when. Okay, so this is all just preamble. It's all build up to what makes these markets move around. Okay, so you have to get familiar with seeing these same signatures over and over and over again, but there's things that work better at certain times when certain macros come in force. In other words, when they start moving price, okay, based on predetermined scenarios, okay, not plan A, plan B. It's the highest probable conditions that leads to a certain criteria that makes the market trade to a specific direction and or time of day, which month, which week of the month. Okay, we'll get into some really exciting stuff, but you're not going to understand it, and it's going to seem like this is too complicated, because you're going to encounter that barrier only if you rush through this part or this portion of the mentorship. If you're not listening and writing down things and then revisiting price action with those insights that I share in my dialogue, you're not going to fully appreciate next year. In fact, you'll probably be very, very, very frustrated, and it will feel like you're not learning anything. And I promise you, if you go through the core content and you go through the lessons that I'm teaching you when we do these weekly reviews, I'm dropping heavy, heavy, heavy bombs of insight. But you can't fully appreciate them until I reveal more things in the lessons. And once those things are taught, you'll be able to refer back to the things I'm saying right now, which don't feel like much at all. They feel like, well, he likes to hear himself talk. That's probably true, but it's also a lot of insight that will be paired up with conceptual applications that you don't have yet. Okay, but you'll remember me saying all these things and say, there it is. Yeah, I can see how that ties together. But it has to be done this way or you won't understand it. And it'll make more sense to you next year when we start going through all that. So, what are we reaching for cable? If we go back out to the daily and zoom in here. This low is the next level, and then the gap that exists in here. We split that up into consequent encroachment and then the full gap closure. I'm not going out on a limb and saying that we're going to take these lows out. Could it do it? Sure. I'm not confident enough to call that much of a move lower, but I am reaching for this as a downside objective. Now, just like we started closing on the highs up here, and I said that when the markets start closing on the high, again, go back and watch that weekly review on May 3rd or May 4th. I'm not sure which day I released it, but it's the week review of that week. Okay, so we close right on the highs on non-farm payroll, and the markets generally top when we start doing that, and we close right on the low. As some of you noticed, we didn't have a TGIF set up this week. Way too heavy. Way too heavy. Just know that sometimes it's going to form, and other times it isn't. And this particular pair here, you can see the breaker on the daily here. They hit it once. They hit it once here, twice, and then a third time here, starting the week on Monday. And it just was all she wrote. So you saw my entry when I went short for last week's 40 pip challenge, and I mentioned don't look at it just for that purpose. Look at it from all facets of trading. Position entry, swing entry, short-term trading, one shot, one kill, and also how it can be used to structure your day trades going short. And that's going to be it for this week. In passing real quick, I'll just say this for CAD. It's still consolidating. I still think that we want to come up here and close this gap in. It looked good last week for a little while, but then it didn't hold up any. Here's the hourly chart, and the insights there are going to be understood when we have that. We have relative equal highs, buy side liquidity pool, buy side liquidity, ran that. Bullish order block, we had a nice little reaction off of that. I'm interested to see how we trade here. If we trade above this gap, that's really, really bullish. Okay, I'd like to see that happen. But we came down last week, closed in this inefficiency, consequent encroachment, rallied through. And zooming out a little bit, there's a sell side liquidity pool resting below these equal lows here. So if we can't get above this gap, or we close it and then fall back through this low, we'll have to put the bullish dollar CAD on the back burner until we probably clear out the liquidity down here. And that still would be fine. I mean, we're in a large consolidation, and it, to me, still looks like it wants to go higher. And if it wants to go higher up to that SIBI, me personally, I would go up here, fill this in, and then sink it hard, run the sell side liquidity out, and then accumulate longs down here and pair it up with an exit up to this SIBI right in here. So that's what that's showing here, consequent encroachment. Let me zoom back out, went a little too far. There we are. So that's consequent encroachment here, and we have buy side liquidity resting above here, and then the SIBI is denoted as seen here. So what am I saying? I'm saying that I'd like to see it go up here. If I could run price, I would run it up, hit that gap that I mentioned on the hourly chart, and then sink it all the way down on one big single down candle. Clear these equal lows out. Don't stay down there long. Accumulate longs and run it up to here. That's what I would personally do if I was making this market, but it doesn't need to do that. It could just keep on grinding up and pop up through on one or two candles on a individual one single day event. Now, what we do at that point, how we trade once we close in that gap or at SIBI, is going to be determined at that time. Right now, that's the only thing I'm looking for. But if we get through it and we trade above it, the relative equal highs here. Okay, so 136.65. But right now, I'm just looking at this. Okay, consequent encroachment as an upside objective. And that, folks, is going to be it. I will touch base with you guys on Wednesday for the review on our back testing. This week, you should be doing a walk forward. And the only thing you're going to be doing is you're going to be testing yourself. And don't be fearful of being wrong, okay? But you're going to be looking for fair value gaps. And when you see that form, you're going to be trading it on paper, not demo, paper, okay? And you're going to track your results with that. And it's going to be very different from what you saw in backtesting, admittedly. But this is how you grow, okay? And you want to do 4 weeks of this. And then at the end of the 4 weeks, we will contrast previous backtesting with walking forward. And I'll give you a lesson on that, okay? So until I talk to you on Wednesday, I wish good luck, good trading. Have a very, very pleasant week, and be safe.